The topic for discussion today is Murphy's call for great Indian banks. Hi, I'm Karan and welcome to Karan's Scan. Today I'll be talking about the news. The news highlights with the recession and crimping loan books, banks face a perfect storm in financial year 2021. I hope you guys understood this beautiful heading. Well, Murphy is basically a person who gave a quote, a very famous quote. He says that anything that can go wrong will definitely go wrong. So he basically says if you think today your tire would puncture, it'll definitely puncture. So this is what Murphy's law says. Anything that can go wrong will definitely go wrong. And Indian bankers are getting a calling from Murphy because their past problems are gonna get amplified by the current pandemic. This is basically an S&P's report. The world's worst bad loan pile. So this is what S&P is calling Indian loans. They're calling Indian loans the world's worst bad loan pile. How shameful is that to a country like India? It says the world's worst bad loan pile is going to increase further this year, and Standard and Poor's analysts put this increase as 13 to 14% of its total loan book. So basically, they are saying out of every 100 loans or out of every 100 crore loan given out, 13 to 14 crore won't be coming back. It's gone. Well, this is higher than the previous peak in financial 2018. As you know, in financial year 2018, a lot of banks were forced, they were literally forced by regulator, which is RBI. RBI literally forced them to reveal their true asset quality through reviews, through stress tests. And this is higher than what happened in financial 2018, financial year 2018. But the difference between financial year 2018 and financial year 2021 is financial year 2018, the country was growing. The country was growing at a good pace. However, financial 2021, India will face a recession. India will see a recession. So that is the difference. You are having bad loans in a bad period compared to bad loans in a good period. What is worse? Obviously, bad loans in a bad period, right? This means that there'll be faster delinquencies, but limited opportunities to recover. So delinquency is basically a duty. So people who borrow money, it's their duty to repay it back, right? So basically delinquency means duty. So if I say delinquencies will increase, that means people are not following their duty, they're not paying back the money. So borrowers aren't paying back the money. So this is just financial lingo you might listen often, and this is what it means. Delinquency means if delinquencies are increasing, a lot of people are not doing their duty, a lot of people are not paying back the money which they owe to the banks. So it says weak companies hard hit by recession are likely to default, and some banks have already seen spike in defaults. Bankers said once moratorium on repayment ends in August, bad loans would surge. Now you need to understand this. RBI has given the lenders, Indian lenders, Indian borrowers a moratorium on interest and EMIs till August. So this means borrowers can choose not to pay their EMIs. Well, there's a difference between borrowers who are choosing not to pay EMI to borrowers who can't pay EMI. There's a difference between those two. So once this dust settles, we would know which borrower can pay EMI and which borrower can't pay EMI. So that's why that's what bankers are saying. Bankers are saying that once moratorium on payment ends in August, bad loans would surge because that's when they would know who's not paying their loans. Moratorium makes it difficult to assess the extent of bad loans, and it also says that good loans may hardly grow. So it's saying that bad loans would increase and good loans to people, credit worthy people or responsible people or people who would pay them back, they would hardly grow. So this is a worrying news for banks. I won't say bad news, but a worrying news. This is a part of business. A recession would mean manufacturers would not invest in long term. All right, and because of recession, the factories would run below their capacity, and hence they won't need a lot of money, which they would need as working capital, and it'll be lesser. So just so that you know, so if you have a factory, the factory is producing products, you would generally get some working capital from the banks, and you would buy raw materials, or you would pay for your labor, and you would get the final product which you would sell out for profit and pay back your bank. So this is what working capital means. Capital for purposes of like labor, basically capital for working capital that you'll need for your business. So this is basically considered under good loan because you are giving working capital to factories that are producing goods, and obviously you have a higher chance to get working capital back because factories take working capital on a continuous basis. They'll take working capital every month, every 2 months. It's on a continuous basis. It's not once in a blue moon that you take housing loan once in a blue moon. You make a you take a mortgage once in a blue moon. You'll take a mortgage twice in your lifetime, right? But working capital, it's taken every month, every week. In fact, some factories, very big factories, can take every week, and this is what a good loan is termed as. So SBI, State Bank of India, the country's largest lender, expects to grow its loan book by about 7 to 8% this year. Now, listen to this statement really carefully. SBI is expecting to increase its loan book by about 7 to 8%. Expecting to increase its loan growth by 7 to 8%. In a recession where factories are running below capacity and factories don't want working capital, they want lesser working capital than before. Smaller businesses are likely to default. There are not many good, there are not many credit-worthy customers coming, or credit-worthy borrowers coming for for procurement of good loans, and good loans are hardly growing. Your bad loans are increasing, and at this stage you are growing your loan book. This stage should be the stage in which they should be careful. Most of its peers also indicated similar growth numbers. So it's basically saying public sector. So SBI is a PSU bank. So other PSU banks have also indicated 7 to 8% loan growth. However, private banks have indicated a slightly healthier loan growth, perhaps to gain some market share. So private banks have reported a 8 to 10% growth in loans. So they want to get a market share at a time where other banks are being cautious to lend money. So now other thing. Now I talked about bad loans. Now if you have a bad loan, if a loan is declared as a NPA and the company has like declared bankruptcy, that company would be taken to IBC, insolvency and bankruptcy court, and the court would decide how much money do banks get, and basically they would sort the matter out. Okay, there'll be a mediator. So what has happened is IBC stands suspended for the year. So the bankers that already have ongoing cases going on, those cases would be continued, that those cases would not be held up. Okay, however, they cannot refer fresh cases to IBC because it stands suspended from the year. So the cases that are already there, they won't be held up, but new cases that would be coming, they won't be referred, and that can be a red flag to you because they're expecting bad loan. S&P is saying bad loan will be 13 to 14% of its total loans, while IBC is suspended for the year. IBC, no new cases won't be referred, and this can be a red flag. Bankers can have a tough time getting their money out. Moreover, IBC doesn't really help with recoveries that much. It helped with recovery for SR Steel, but SR Steel is a big corporation. But if I see recoveries for smaller companies, IBC doesn't really help that much. Okay, they'll help with a fraction of loan amount, but they won't be able to help bank with a good chunk of the loan that is due. So, simply put, bankers have been betting on a revival of economic growth for recoveries to increase. Instead, they have to contend with this year as a recession. So, they were like, hoping some growth to come in the coming year so that they get more recoveries. Okay, but it feels as if they have been hit by Murphy's law, and what can go, if anything can go wrong, it'll definitely go wrong. So that's what, if their loan book will go wrong, it'll definitely go wrong. So this is the Murphy's call to Indian banks. They have got a recession this year, and their recoveries won't increase. In fact, a lot of more bad loans will be generated. Indian banks are in a perfect storm this year, with recession crimping the loan book and hitting its quality as well. Now, there was another report by Fitch. So I told you the three rating companies: S&P, Standard and Poor, Fitch, and Moody's. So Fitch is also saying that lenders would need more capital of about $15 billion in order to survive in this market, in order to see the end of the day. So, guys, this is pretty much it about Murphy's call for great Indian banks, and I hope you like this video. And if you want more quality content, please subscribe to my channel. Have a nice day.